So one of the things I like about Disney, if you're a good backup QB, you can make $2 to $4 million a year for 20 years, accepting of commercials. Let's call it 170 billion, and they did 30 billion in profit. What's the right price to pay for the stock? Okay, guys, Disney stock. They reported last week, Bobby Iger, Mikey's BFF forever. They beat, did they beat? I don't remember what they did.
Let's double check that while you keep going.
So one of the things I like about Disney, well, there's a couple things I like about Disney. First off, moat. Moat of all moats.
Yes.
Look at the market cap of Disney. Market cap of Disney is $197 billion. If I gave you $200 billion today and said, create another Disney, you ain't doing it.
Oh, give me 400 billion.
You're not replacing Disney with that money. What do they report?
They reported they beat on earnings per share by about 30%.
Wow.
And they matched revenue.
Okay, so the other thing about Disney is ESPN. Guys, I've been saying this. What was that?
It's carrying them right now.
Is it carrying them?
I mean, there's a lot of talk about how Disney Plus is becoming stagnant.
Yeah, but they grew like crazy.
For now, of course, yeah.
There was talk about them spinning off Disney. I mean, ESPN.
There was. That was under Chapek. And now Iger's saying the opposite way.
Yeah, there's no way he's going to do that.
And then now, big thing is, what are they going to do with Hulu?
So here's the thing. Sports. The world of advertising. Yesterday was the Super Bowl. So if you're watching this, we're recording this the day after the Super Bowl. By the way, Chad Henne, Michigan great, just retired right after the Super Bowl. He said he's done. Now, granted, he was a backup for a ton of years, but he was a backup for like 13 years and made $38 million. That's not bad.
I think the best job in pro sports is a backup
QB.
Yeah.
If you're a good backup QB, you can make $2 to $4 million a year for 20 years. Now, a 30-second commercial, I think sold for upwards of $7 million. And as time goes on, people become more and more into streaming. There's gonna be less and less commercials. So where's the one area people don't stream, that people don't record and watch later? Sports. It's literally impossible for you not to know who, within a minute of the Super Bowl being over, I got 4 notifications on my news article saying Kansas City Chiefs won, Kansas City Chiefs won, Kansas City Chiefs won. Yeah. Right? So
unless you have a flip phone, you know.
Correct. And even if you have a flip phone, I'm quite sure you probably don't even know what sports are. You probably have no friends, so you weren't watching.
Or you don't know what day it is.
So sports are a very, very important part for advertising revenue someday. You look at all the sports franchises, they've skyrocketed in value in the last few years. Why? Because the advertising rights, the advertising revenue that was shared, that was sold by those leagues to the ESPN, CBS, Fox, all those places is huge and will generate more and more money as the world becomes less and less accepting of commercials. Yeah. Mo, a couple times lately, you've told me like, hey, did you see this commercial? I'm like, no.
That was Darnell.
No, that was you too. Remember on that drug I was telling you about?
Oh, yes. That where do I
was like, hey, you heard of this drug?
Oh,
and you're like, yeah, I saw the commercials. I'm like, what the hell commercial are you talking about?
What am I watching? Maybe it's because I'm watching MLB Network or something. Because I don't know. I'm trying to think of what I watch.
It's got to be live TV. It's got to be sports.
Exactly. I don't watch anything that's like not I record it. I ain't watching commercials, so it must be MLB Network.
I don't even record, by the way. I don't record anymore.
Maybe it's CNBC that I catch it. Yeah, maybe it's something like that.
So anyhow, now the interesting thing about Disney. So first off, if already we're saying things that ring to you like, subscribe to the channel. It's a great way to learn. We have a different way of looking at things. Instead of saying we are value investors, we actually talk the talk and walk the walk. 99% of people who say they're value investors will absolutely cry and scream when prices fall. We encourage it.
How much do you think that costs Disney?
Chiefs head to Disneyland Resort. I'm sure there's some sort of deal they have with them.
I love it.
I'm sure there's some sort of deal that happens.
Yeah, it has to be. It's great.
Guys, look at this revenue. So we have revenue here the last decade, 46, 50, 54, 55, 55, 59, 75, dropped to 60 during COVID. Why?
Nobody went to the parks. Nobody went on cruises.
40% of the revenue was parks and cruises and entertainment, those kind of things, and it went to zero for a very long period of time.
But that year, I believe they got a huge bump from Disney Plus.
Yeah, but how much of a bump? I mean, how much is Disney Plus? Even if it's $8 a month and you had 100 million subscribers, actually, it's a pretty good chunk of change, actually. Yeah. Pretty good chunk of change. So now Disney Plus has hit, I mean, they skyrocketed so much, it's kind of hard to compare.
Yeah, that's the thing.
Now, one thing I want to make note here. So record revenue, but look at the profit. The profit went from 6.5, 7, 8, 9, 9, 11, 11, 10, 4, loss of 5, 3, and 3, 3. So even with the rebound and catapulting revenue, they're still not making the revenue they used to make. 11 billion. So right here, let's call this an average of $10 billion in those 3 years, 16, 17, 18. They did total revenue of 170 billion. So they did 170, they did basically, let's call it 170 billion, and they did 30 billion in profit. So what is that? 13 out of 7. So what is that? 17%, something like that? I don't know. And then last year they did 3 billion on 84. So the profit margin is absolute garbage. Yes. Even their 5-year profit margin is garbage. So the thing I would say about Disney is they haven't gotten back to real profitability. Right. Look at the 8 pillars.
8 pillars, and I was like, yikes.
Look at it. Why don't you walk through people?
Okay, so guys, this is a lot of X's. And a couple of things that I'm not liking right here. The return on invested capital. Now, this could, of course, be skewed because of the last 3 years for them has been an incredibly rough period. Cash flow growth. Again, Paul, I look at a lot of these things, and I'm not surprised. But the hard thing is, when does this return to normal? That's the real question. And it doesn't, it seems like revenue is still flossing, but profit is not even close yet. Paul, they need to do over 100% jump in profit to get back to that probably average of 10 billion.
So that's the thing that you need to research on this. And one way, I'm sure somebody in our community has researched this and has seen what is the reason why their profit still has not rebounded even though revenue has. And especially if revenue's big jump is Disney Plus, I gotta think the gross margin on that Disney Plus is huge. What are you looking at?
I'm looking at how their cash flow was 6.6, 6.7, 7.3, 7. And then
1.
1. This was huge. Changes in working capital.
Listen, like I said, the question you have to ask yourself is, can they get back to the same profit margin? Yeah. If they can, and they do $84 billion in revenue, and they're at 17%, what is that? So that's 8.4 billion and 7 times, so call it $14 billion in profit. That's the question. Can they get back to their old profit margin of 15, 16, 17%? If they can, how much is this company worth?
Right.
Look at the free cash flow. What was the free cash flow, Mo?
Free cash flow average is 3.16. Before that, they were probably averaging.
So those 2 years of 9.5 each, 17 and 18. So that's 19 billion. And the revenue on that was 19 billion. What was it, 17 and 18, I said? Mm-hmm. 19 billion on
basically
115. Billion. So again, 12 or 13%. Yeah. So guys, even if it's 12%, they're now showing less than 4%. The question is this the new normal for them, or are they going to get back to more normal levels?
Right.
If I were to guess, you don't go through these big periods and just fall down to the wayside here. Look at 2013. They made 6.6 billion on 46 billion. That's about 16, 17%. 7.8 billion on 50, right? That's 15%, 16%. I have to think this is still a small number, but I want to understand if that's right. Well, definitely not the $5 billion loss,
right?
But you definitely need to understand. Now, the other thing I want to look at, I'm gonna look at their balance sheet, Mo. How did their long-term debt change over the last long-term liabilities? Oof.
Yeah, that's bad.
That's rough. They took a lot of debt, but they're paying it down now. No, they're paying it down. Look at this.
Oh, they took, because they had. That's right.
Did they add, what did they do? Did they take shareholders? Did they dilute?
They did dilute. And
did they?
They did something during.
Barely.
Oh, was it barely?
Yeah.
Maybe they took on a lot of debt because of COVID.
That's what I mean.
Yeah.
But the question is, do they pay it back? Are they paying it back through cash flow or through share dilution? Now, I like this. Through COVID time, this is probably an acquisition right here.
Oh, okay. Okay. I was looking at the wrong year. Oh, 1.49 jumping to 1.18. That had to be an acquisition.
1.81?
Yes.
And look, it's barely up through COVID. Okay.
Is that 18?
So these are good things. And before they took on this, whatever the acquisition this was, my guess is...
There was no acquisition.
Then what was it?
I don't know.
How did they all of a sudden issue 300 million more shares? But they were paying down all along the way. Look at that, 1.76. They're buying back shares all along the way. All right. So let's see what analysts are saying about the company. Profit, definitely, they're saying it's going to double. That's over double in the next 4 years. That's 20% plus growth. Revenue, not much growth, but still there. Still mid-single digit growth rates. All right. So, Mo, what are you looking at?
So I see if there's with this acquisition.
Look at that. 20th Century Fox for $71.3 billion in cash and stock.
There you go.
Oh, there it is.
There you go.
Can you see what the number of shares were?
Let's see here.
In cash at $38 per share in cash and stock. 50% cash, 50% stock. How many shares outstanding was that? Because it's $19 per share. So we'd estimate if it's 300 million.
It was 1.49 at the time, jumped to 1.81.
Yeah, so it's 300 million shares times 19 was 5.7 billion. That was half of it. So they buy it for like 11, 12 billion dollars. No, 71.3. How does that math work out? Oh, look at that. 343 million new shares. Interesting.
Yeah, you go. Quick Google search gives you all the answers.
All right, great. So that answers it.
Not a Bing search, by the way.
Oh, then there's a number of Disney shares that are, okay, gotcha. Then there was a change of Disney shares as well. I was going to say, that's not an $11 billion transaction. All right, so we can say all this till we're blue in the face. The question ends up being, like usual, what's the right price to pay for the stock? And that's why we have the stock analyzer tool. So if you like this so far, we are running a special, $7 for 7 days on our software. Check it out. You get this, the community, all these other tools that will not just help you with the numbers. They'll help you with the emotional side of investing. That's the hardest part. You can know the numbers so you're blue in the face. If you're going to sell every time the stock goes down, you're not going to do well in investing. And we're here to help change that in everyone out there. So I'm going to do a 20-year analysis. Mo, you're going to do 10?
Yeah, I'll do 10.
Now, for those of you who are new, go ahead, Mo.
No, I'm just thinking.
Okay, for those of you who are new, the reason I do 20 years is because Disney's the kind of company that I want to own forever. So the longest our years of analysis goes is 20 years, so I'm going to go factor that in there. Now we're going to do revenue growth, profit margin, and go along the way.
Okay, this ought to be fun.
Yeah, it's going to be tough. Yeah, I don't know if that high number is realistic. Free cash flow margin. This is kind of difficult.
This is harder than I thought it was.
Well, because the last 4 or 5 years have been tough for both profit and free cash flow.
Right.
All right, Mo, why don't you run through the numbers over there? What did you get on your revenue growth?
So revenue growth, I did 3, 6, and 9.
Okay, I did 3, 5, and 7 for 20 years.
Okay.
Because I look at it going, there's no, I mean, I'm actually even upset using 3 on the low side.
So I will say, I mean,
I'm changing mine.
Revenue being 80-some million, 80-some billion, 87 billion, whatever it is right now, that I feel like it's going to come closer to that 60 to 70 range, come back down.
You think so?
I do.
Why?
Because look how stable it was. I mean, what would be the reason for, it was very, very stable, and then all of a sudden you get these big jumps. I don't know what this was. Was that the acquisition or something?
Yeah.
Okay. And I just don't see how it's going to stabilize around here. I would be more comfortable saying it's going to stabilize around 70.
All right, Mo, what do you have for profit margin?
Profit margin, 6, 10, and 14.
I did 8, 12, and 16.
Okay.
By the way, the funny thing is they've done 16.
Yeah.
I look at it going, okay, well, let's see. Okay, next one, free cash flow margin.
5, 8, and 11.
7, 10, 13.
PE and price to free cash flow, 16, 17, 18.
Both of those I did 15, 16 and a half, 18.
Okay, and my returns were 10, 12, and 14.
I did the same thing, and again, because I beat these things up,
Yep.
I want to go low on the. I'm fine being at the market return, essentially intrinsic value, because I beat up the other ones so much. So I hit the analyze button. The stock's currently at 108.
42 to 35, 125, 98. Look at that, free cash flow's lower, and about $80 to $60 in that middle range.
50 to 60. 80 to basically 100, 108 to 133, and I have it on my watch list at 80 because I want to buy it then and start selling puts. Thanks very much, guys. Don't forget to subscribe and check out everythingmoney.com, $7, 7 days, risk-free.